Welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We are Central Florida's longest running radio program, coming to you on a host of radio stations throughout Central Florida. We are also one of the top 25 financial planning podcasts of the World Wide Web with over 40,000 downloads of our program. My name is Chet Cowart. I am a certified financial fiduciary at Nelson Financial Planning, joined by Kristin Castello, certified financial fiduciary, certified financial planner, CPA, all of the above, also at Nelson Financial Planning. Be sure to subscribe to our channel, favorite social media podcast platform of your choice. If you have trouble finding us, go to our website, nelsonfinancialplanning.com. Look in the upper right-hand corner, click on the icon that looks most familiar to you, and you will get instantly connected to our channel. So, pretty cold this morning, huh, Kristin?
Yeah, it's been a really cold week. We got a little bit of sun this weekend, though. That was nice.
Yeah, it's heating up a little bit. I am not a fan of the cold. I will be honest with you, Florida boy through and through, and it gets to me pretty quickly. I get a little sick every time it gets cold. So, getting through that. I don't know if you guys can hear it in my voice, but we're going to make the show happen either way. So we're excited to be here.
Yeah. And Joel is out this week. Joel Garris, our normal host. He will be back next week to join us.
Yep, we are the sit-ins this week, and we will be, taking it over for the time being. So some points from last week. We had an educational event with a senior investment portfolio manager specializing in growth funds. We hold these every quarter for our clients. It's a fun little event for our clients. We have dinner, drinks. Speaker comes in and kind of gives us the rundown of the market as a whole. There were some great points, one of which being the weight of Mag 7, which are sort of the biggest growth companies in the market, so to speak, nowadays. Their weight in a lot of the indexes, such as the Russell 1000 and the S&P 500, they've become, I guess, a little bit overweight, some would say. They, what used to be a pretty diversified index is now almost, in the S&P 500, 34% of that index is now these 7 companies. In the Russell 1000, that's up to 56%. So it's become a pretty interesting sort of, weirdly weighted index, hasn't it now?
Right. And what the portfolio manager was saying is that a lot of that overweight has come from earnings. Mm-hmm. And that the gap in earnings and growth between these stocks and the rest of the index is diminishing, which actually creates an opportunity for active management to add value over time.
Yeah. I mean, we're very optimistic for future growth. These companies are still performing well. It's nothing to necessarily be afraid of, but it is an interesting thing if you are and have been a strictly index investor going or in the past. Going forward, it's a little bit different now because it's not quite as diversified as it once was. It's an interesting thing. Active management and some of these sector-driven funds may be an interesting choice going forward, maybe perform a little bit better.
Right. And we also talked a lot about AI and what that looks like in the future. So the big thing that is coming out now is that AI takes a lot of processing power. So they need new data centers to process the AI searches, all of that sort of stuff. So when it comes to creating these data centers, it's not just the energy that's behind it, but the actual manufacturing companies. Mm-hmm. So there's just a lot of opportunities for growth companies and growth stocks coming forward. Right.
It's the whole, don't always go after the gold, go after the companies that make the shovels that the people use to dig up the gold. So
exactly.
There's opportunities everywhere. It's not just, in the actual AI companies, it's the companies that support those companies as well. So today we're going to be talking about, for every year in the beginning of January, we give a list of our top 10 tax changes to all of our clients. It is a client-specific document that we send out. Now that a little bit of time has passed, we are going to be talking about that today. So we've got 10 tax changes that are going to be happening going forward. We've got a little bit about each one that we'll be getting into. So Kristin, what's the first one? What are we getting into?
Yeah. So kind of looking at the top 10 tax changes as a whole, it's not very exciting this year. We've seen some provisions that came out in 2022, 2023, 2024 even that really haven't been implemented. So some of these we've talked about before, But that's not to say that we're not going to see a lot of tax changes throughout 2025. So with Trump now in office, there might be a whole litany of changes. We've talked about a couple of them on previous radio shows where we could see something like no tax on tips, no tax on overtime, no tax on Social Security. How likely are those changes going to be? I'm not too sure, but we'll keep you updated along the way. So we'll kind of dive into the first one here. So the biggest tax change that we have is that the Tax Cuts and Jobs Act from 2017 is set to expire at the end of 2025. So now take this with a giant asterisk because this is barring any future legislation. So Trump has said all along the campaign trail that he extends to extend many of the provisions, if not all of them, to make them permanent. So we're kind of going under the assumption that it is set to expire, but it could go either way. We could have these provisions moving forward.
Right. This is one of those things where, as of right now, things are set to expire. Tax rates could hypothetically go up, but if we're going based off of what Trump has said he's going to do, things will hopefully remain the same going forward. What would those brackets look like if things did change? If he let those changes expire?
So this will be the biggest and most impactful change. It would be to the tax brackets. So looking at individual rates now, we are in brackets that are 10, 12, 22, 24, 32, 35, and 37. So moving forward, each bracket, except the 10% bracket, is going to go up about 2 or 3%. So these new brackets would look like 10%, 15%, 25%, 28%, 33, 35, and 39.6. So it's a big change. So 2 to 3% for almost everybody. It's a pretty big increase in taxes there.
Yeah, you would feel that.
Exactly. Yes. And another big one that we would lose is the qualified business income deduction. So this deduction allows qualified pass-through entities such as S corporations, partnerships, and Schedule C sole proprietors to take up to a 20% deduction against their business income. There are some income limitations on it, but it's basically a free 20% deduction for all those that qualify. So if this were set to expire, so it is set to expire at the end of 2025, and if it does expire, it's going to impact millions and millions of small businesses.
Right, and I'm certainly not a fan of paying more taxes. I would imagine that all of you listeners would agree with me on that one. So hopefully these provisions remain extended or permanently put in place. We would all like that. And also that was a big point of Trump's reelection. His campaign was extending these. So I would imagine that he at least guns for that, and we would certainly hope so. There's some other changes with the Tax Cuts and Jobs Act. What are some of those?
So the Tax Cuts and Jobs Act also limited many itemized deductions that we may see come back. The act also doubled the standard deduction. So really the point of the Tax Cuts and Jobs Act was to simplify the tax return. So every individual can take either a standard deduction or itemize your deductions. But by doubling the standard deduction, it really reduced how many people itemize nowadays. So looking at the percentages on that, so it used to be that 30% of people itemize their deductions, but after the Tax Cuts and Jobs Act, that is now about 10%. So a pretty significant decrease in the amount of people that itemize their deductions now. So some things that we may see come back are removing the $10,000 cap on state and local taxes. So now those that live in higher income tax states like New York, California, Massachusetts, you can now take advantage of deducting, or if this does expire in 2025, you'd be able to take take advantage of the unlimited SALT deduction. You could also see potential for personal casualty losses to come back. Unreimbursed employee expenses. This was a huge one during COVID with employees working from home. So you'd be able to deduct a portion of your home office expenses should this deduction come back.
Yeah, and as much as everybody harps on tax brackets and income tax rates, the standard deduction is a big one. That's one that you will certainly feel if that goes back to where it was. So yeah, a lot of changes could be coming our way. It's a lot to keep up with for the people out there. So we empathize with that, obviously, and that's why we're here. We're here to lay all this out for you and help let you know what you can do to prepare for these things. So, what should we do to plan for these changes?
Yeah. So we really have two options. We kind of wait and see. We see if it expires or it doesn't.
Right.
So likely we're not going to know what that's going to look like till year end. But we will keep you updated along the way on our podcast every week here and on the radio show. So as we hear things, we will let our listeners know.
Absolutely. And this is Chet Cowart and Kristin Castello with Nelson Financial Planning. We'll be right back with you.
So before the break, we were talking about the top 10 tax changes, and the first one we were going over was the expiration of the Tax Cuts and Job Act from back in 2017.
Right, absolutely, and a lot of potential changes here on that act. It's sort of still up in the air whether or not Trump's and his administration lets that expire, or whether he reenacts it and continues to. We continue to have that going forward, mostly to do with the standard deduction amount and income tax brackets. So curious to see where that will go going forward. We left off going over some things that people can do to prepare for these changes. What are some of those things?
So yes, it's going to be hard to tell. So we really won't know too much until probably towards the end of the year. That's usually when most of the tax legislation comes out. So there's really two approaches here. So we can move forward as if it is going to expire. So in that approach, what you'll want to do is push more income into 2025 while the individual rates are lower. So as the tax brackets go up next year, so about 2 to 3% per tax bracket, it would be more beneficial if you are taxed in 2025 when the rates are lower. So if you're a business, see if your vendors can prepay or send you your bills earlier. That would make it so the income is pushed to 2025 versus 2026. Individuals, you will want to bunch your itemized deductions and push those to 2026 for a larger benefit. For example, if you're planning to make a $10,000 charitable deduction, that alone will not allow you to itemize in 2025. But if you wait till 2026 and you combine that with the unlimited state and local tax deduction, and because the standard deduction would go down in 2026, that would provide you with a better benefit.
Right, that makes sense. If we expect taxes to go up, it would be better to pay more of them while the rates are low this year than going forward. But I think we can all agree that we all hope those rules from the past stay and continue going forward. And considering how much of a campaign point that was going forward or throughout the campaign trail, and I think those changes will likely continue going forward. So we all hope for that. Continuing on in the list, we have some interesting things, one of which being increased limits for retirement accounts and catch-up contributions. These are things that happen every couple of years, so nothing groundbreaking here. But there is some weird things. So when it comes to employer plans like 401ks, 403bs, 457s, the plan limits are increased from $23,000 in 2024 up to $23,500 in 2025. The interesting thing is that there's some new brackets for catch-up contributions. So these were the things, when you were between 50 and 59, you could contribute more to these plans on a pre-tax basis in order to sort of catch up with your retirement savings. The new thing is that they, as well as them going up from 50 to 59, you can still make the same ones. And then from 64 plus, you follow the same catch-up contribution as if you were 50 to 59. But now if you are between 60 and 63, there's a catch-up contribution of $11,250. So for some reason, with that 3-year age bracket, 60 to 63, you have a higher catch-up contribution than 59 or 50 to 59, but then also 64 plus. It's a very strange thing. What do you think about that, Kristin?
It is very weird. I get the intent behind it is to have people save more for retirement as they're getting closer to retirement and as they're in their higher paying years, but it just sounds like a nightmare for payroll processing companies because they're going to have to double check what the age is. So once you hit 50, you're able to do the catch-up. But now you got to watch for not only are they over 50, but are they between the ages of 60 and 63? And then once they hit 64, you have to go back down to the lower catch-up. It's a very weird provision.
And I understand the premise of catch-up contributions. I think we all do. I just don't understand why the premise of between the ages of 60 and 63, you would need to contribute more than if you were 64 plus. You would think that if we're going to have catch-up contributions that go up with age, the 64 plus age bracket would be the highest one. So a little weird there. In terms of just all of the numbers, traditional and Roth IRA limits, they remain at 7,000 with the catch-up being an extra 1,000. Simple IRA limits increased from 16,000 in 2024 to 16,500 in 2025. There's a new catch-up contribution for simple IRAs that's based upon your age. It's also that same kind of 50 to 59 or 64 plus. They can make the $3,500 catch-up contribution, and then if you are between 60 and 63, the catch-up contribution is $5,250. SEP IRA limits increased from 69,000 to 70,000, and then HSA limits for individual plans from 4,150 in 2024 to 4,300 in 2025, and then family plans 8,300 in 2024 to 8,550 in 2025. And then if you are an HSA holder, age 55 plus, you may contribute an extra 1,000. So generally, the same increases that we are used to seeing every couple years. But I just thought it was very interesting that weird 3-year gap in the middle there where you can contribute more than every other age. It's kind of strange.
It is. So key takeaway, if you're maxing out your 401ks or simple IRA plans, make sure you just pay careful attention based upon your age to what that maximum is this year for you.
Right. And then always, the same as it has been discussing Roth versus pre-tax, a lot of confusion here still to this day. Simple explanation just being Roth is contributing with after-tax dollars. The growth is then tax-free upon retirement, and then pre-tax, that is the dollars that you contribute, and then, they come off of your tax return that same year. And then the growth is tax-deferred, and you pay taxes on the balance in retirement. So always important to remember those differences, deciding which one is best for you. It kind of comes down to, are you in your highest earning years now, or will you be in a higher tax bracket later? It's a little, there's not a blanket answer on which one is best for everybody. It kind of depends on your individual situation. Are you 20 years old, making $15 an hour? Then Roth is probably the right thing to do for you. Or are you 50 years old making $400,000 a year? Then Roth is probably not the best idea for you. Obviously, it's not that easy to figure out, but that's the general premise. So always important to remember those things. So anyways, what is the next change, Kristin?
So the third change on our list is that the beneficial ownership information reports, that's the BOI report that everybody was talking about last year. So this report is on hold. So it was set to go into effect January 1st of 2024. It required many U.S. small business owners to file their beneficial ownership information report by year end or incur a pretty big penalty. It was close to $600 per day. So thank goodness that didn't actually get implemented. So when they kind of ran the numbers on this, it was honestly a huge relief that it was put on hold, because it's really targeted at small businesses. So nearly 32 million small businesses would have been required to file this report by December of 2024, and only an estimated 9.1 million had done so by then. Mm-hmm. So it was a huge relief that they did put this on hold. We don't expect to see it become off hold. We expect to see it not be enforced, but it is an ongoing legal issue, so we will keep you informed if we see it reversed in the future.
Right, and I remember just, in our own office, that was a big talking point, whether or not that needed to happen. We fell under that umbrella of going back and forth on if this was going to be required, and it was interesting to see. It's the same situation with a lot of IRS rules where no one exactly knows where you fall on those sorts of things. So So very interesting. Going forward, more changes regarding standard deductions and inflation. What's going on with that?
Yep, so just the usual inflational changes that we see to the standard deduction. So if you're married, your standard deduction was $29,200 in 2024, and in 2025 it's increasing to $30,000. If you're single, it was $14,600 in 2024, and that's increasing to $15,000 in 2025. Additionally, there is the additional deduction for those that are 65 and older or legally blind. So if you're married, that comes out to be $1,600 per person, or if you're single, then it's $2,000.
right? And we love having the high standard deductions. We hope those stay. And when we get back, we've got some more tax changes for you. We're only about halfway through the list, so we got plenty more. This has been Chet Cowart and Kristin Castello, both certified financial fiduciaries with Nelson Financial Planning. Got much more tax changes for you when we return. Number 5, the RMD required minimum distribution age is remaining 73, so no change there. But the shortfall penalty is decreased, meaning the penalty that you pay for any amount of missed RMD. So when it comes to your retirement accounts, the RMD age is remaining 73. We do have notice that in 2033, the RMD age will increase from 73 to 75. The age for QCDs, qualified charitable distributions to churches, nonprofits, charities, that sort of thing, that remains at 70 and a half. That stays at the old RMD age. But then additionally, the shortfall penalty, meaning the amount that you pay for missed RMD amounts, is now 25%. That was 50% at one point. And in some cases, only a 10% penalty may apply if you withdraw the missed RMD within the following year. So essentially, a lot more leniency on missed RMDs. The penalty and the amount that you pay for missing those amounts is quite a bit less now. So that is nice. It decreases by half. So that's going to be good for a lot of people going forward. We have a lot of clients that are required to take that are above 73. So that will be a nice little boost going forward.
Right. And something that you mentioned that a lot of people do forget is that the qualified charitable distribution age is 70 and a half. Mm-hmm. So you do not have to wait until your regular RMD age of 73. So if you are charitable minded, you can start making those QCDs as soon as 70 and a half.
Right. Yep, that has stayed at where the RMD age was a few years ago. So that's interesting. I wonder why that has not changed. It's an interesting little thing there. And then going forward, one thing that is involving RMDs that is not so beneficial for everybody is that there is no more penalty relief for missed RMDs on beneficiary IRAs inherited 2020 or after. So if you guys remember, the rules changed in 2020 when it comes to inherited retirement accounts as to where you can no longer stretch it across your entire lifetime on your own lifetime table. Now it is over a 10-year period. The account has to be liquidated. Taxes have to be paid on it. From 2020 up until now, there has been relief on missed RMDs as to where you did not have to pay any penalty on a missed amount. That's mostly just been because of all of the confusion coming from the government in regards to rulings on what was required, what wasn't. There was some confusion on if it only had to be liquidated over a 10-year period and there was no RMD requirement, or if there was both an RMD requirement and the 10-year period requirement. So now we've got some ruling on that. There is both. You do have to take an RMD and it needs to be liquidated over a 10-year period. But with that being said, over the last couple of years, if you missed an RMD, there was no penalty on that. There was some penalty relief. But unfortunately, that is not going to be the case going forward. So starting now in 2025, there's going to be no relief for that. So you need to take your RMDs from these inherited accounts. And if you don't, you will pay a penalty. So I think that's something that will affect a lot of our clients going forward. A lot of them were aware of the penalty relief and were not taking RMDs. And that's not something that can happen going forward.
Yeah, and the rules on it are still very confusing. So when it comes down to who needs to take an RMD, it really depends on the decedent's age when they passed away. So if they were in RMD age, so when they passed away, if they were taking RMDs, then you, when you inherited the account, need to continue taking those RMDs.
Right.
Now, if the decedent was younger and had not hit their RMD age, then you as the beneficiary do not have to take an RMD. You just have to liquidate the account within 10 years. So it is pretty confusing. There are some online calculators that can help. We are here to help with that. We help our clients with that on a daily basis, it seems like now, because the rules have been laxed for the past couple of years, and now that it is being implemented, we want to make sure that everybody is meeting the requirement and not paying the 25% penalty.
And there's still a ton of confusion around all of those rules, and rightfully so. There's a lot going on, a lot of moving parts. A lot of confusion on why the RMD amount is so small compared to If it has to be liquidated in 10 years, you would think it would be around a tenth of the account. It's certainly not. If the account is still invested, there's a big chance that even if you are taking your RMDs, the balance of the account is bigger in the 10th year than when you even started 10 years ago. So
Right.
A lot of weird rules on that and a lot of confusion. But it's nice to finally get some ruling that can kind of guide us in the right direction. So next, change number 7 is another previously passed tax provision that's taken a while to get implemented. So tell us a little bit about that.
So this is the 1099-K reporting requirements. You have heard us talk about this a few times on the program. It's always kind of been up for confusion. How are they going to implement it? Now this is another one that could impact many of you, so make sure that you're paying attention to this part. Form 1099-K reports payments that you receive for goods or services during the year from debit, credit card transactions, or anything through something like an online platform for payments, like Venmo, PayPal, Square, Facebook Marketplace, anything along those lines. So these platforms are used very frequently by small businesses to collect payments from individuals or to sell items on it. So think Etsy, that sort of thing. You will probably receive a 1099-K if you sell things on Etsy. Mm-hmm. So under the previous rules, Form 1099-K was only required if an individual or a business incurred over 200 transactions or gross payments over $20,000. So that really was people that were in business. If you just have something in your garage that you want to sell for a one-time, $200 payment, that sort of thing, you wouldn't receive a Form 1099-K for that.
You'd have to be running a pretty big garage sale to get over that limit.
Yes. So now under the current rules, starting in 2024, the threshold for that went down from $20,000 down to $5,000. And now in 2025, it falls down to $600. So that's a pretty big change, going from $20,000 down to $600. So many of us could accidentally trigger that by selling concert tickets, old things around the house. Maybe if you have a very small business on Etsy where you're selling some crafts, you might trigger that threshold. So just be aware, you may unexpectedly receive Form 1099-K for personal transactions as well. So there's been some confusion on how apps like Venmo or Cash App are going to distinguish between personal payments and business payments. So it's been a couple years since they put out these rules. So what I'm hoping is these platforms have kind of adjusted by now and figured out who's personal and who's business accounts. But it's worth double checking. So as tax season approaches, just make sure you're kind of checking all of these counts to make sure that if you received a tax form, you make sure to report it.
Yeah, that's something that can affect a lot of people. I mean, not recently for me, so I don't think I have to worry about these tax forms. But I know in the past I've bought and sold plenty of things on Facebook Marketplace, cars, boats, golf clubs, all these things. And now going forward, those just simple transactions you do on a personal basis can certainly generate a tax consequence for you that may not have been there in the past.
Exactly. Yeah. So we have a few tips for you to keep in mind when it comes to this form, especially this tax season, if you do receive a form, because the thresholds have gone down a bit. So if you receive a W-4, this is a form from any company that could be like a Ticketmaster, StubHub, Etsy, Facebook Marketplace. Essentially what they're doing is requesting your social security number. So if you receive this form from any company, then you will likely be receiving a tax form from them. So keep that in mind if you've received it at any point, or even when you signed up for the company. If it's Ticketmaster or something like that, make sure that you're checking to see if you received a tax form. If you have a small business, make sure that you're double checking to make sure that you received all your 1099-Ks and you're reporting that on your Schedule C or your business tax return, even if you haven't done that in prior years. So even if you hadn't filed a Schedule C for sole proprietor, if you're just selling small crafts that never triggered that threshold in the past, make sure that you start doing it moving forward. And if you just sell personal items, so this typically ends up in a loss for most individuals. So I know I've sold a couple things, end up selling it for less than what I purchased them for. Chet, have you sold anything this past year?
Not this past year. I know I sold my old Toyota Camry that I was driving around for years. I sold that on Facebook Marketplace, certainly at a loss. So yeah, but absolutely yes, I have sold a lot and bought a lot on these buyer to buyer platforms but yes, most of the time at a loss. So I feel that's the same for most people.
Yeah. So what happens is, unfortunately, Facebook Marketplace doesn't know that you sold this at a loss.
Right.
So they're still going to issue you the tax form that says you sold this car at, let's just say $2,000. You might have paid much more than that, so 5,000 or something like that. So technically you are at a loss, but on your tax return you still have to report that you had this income coming in.
Right.
So after the break here, we'll let you know how to report that and kind of other things that you need to watch out for.
Absolutely. We'll be right back. Thank you. Welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We are Central Florida's longest-running radio program, coming to you on a host of radio stations throughout Central Florida. We are also one of the top 25 financial planning podcasts in the world, with over 40,000 downloads of our program. Be sure to subscribe to our channel on your favorite social media and podcast platform of choice. If you have any trouble finding us, just go to our website, nelsonfinancialplanning.com, and look in the upper right-hand corner. Click on the icon that looks most familiar to you, and you will be instantly connected to our channel. So my name is Chet Cowart. I am a certified financial fiduciary at Nelson Financial Planning. I am here with Kristin Castello, also a certified financial fiduciary at Nelson Financial Planning, where we stand ready to help you change your life this week with a successful and cost-effective financial plan with superior investment results. And we are here with some more tax changes. We were going through a lot of them before the break. Only got through about half of one before the break, so we're going to pick up right there. Kristin, where were we right before the break?
So we were talking about Form 1099-K. So this is a form that reports payments that you receive through online payment platforms like Venmo, PayPal, Square, that sort of thing. So we were talking about what do you do if you receive one of these forms for a personal item that you sold actually at a loss. So before the break, we were talking about an example of Chet, who sold his car at some point on Facebook Marketplace. So it was sold at a loss, so he purchased the car for more than he ended up selling it for years later. So what do you do in that circumstance? So if you receive a Form 1099-K from one of these payment platforms, and it is at a loss for a personal item that you sold, what you'll do is you'll still report it on your tax return. So, for example, last year I sold some old home improvement stuff that I ended up buying, and I had extra paint, so I sold the paint. I purchased it for $150. I sold it for $50. So it was obviously at a loss, so a $100 loss. Now, personal losses are not deductible on your tax return, but because I sold an item through one of these payment platforms, I may receive a Form 1099-K for that transaction. So what I will want to do is if I get that tax form, I'll report that I received $50 of proceeds from selling the paint. I'll say that I paid $150 for it, and then on the tax return, net that out to $0. So essentially, it's a tax-free transaction because it was at a loss. But because it was a personal loss, I can't actually deduct the fact that I lost $100 on the transaction there.
Right. It's not saving you in taxes. You're just not paying taxes on it. It's yeah, exactly.
Right. So the main thing for everybody to watch out for this year is to double check all of these platforms and see if you have a tax form from it. And if you did receive one and it's an error, so if it's for Venmo and all you do is reimburse your family or they reimburse you, just number one rule is don't panic. So the first thing that you're going to want to do is make sure that you keep the tax form and report it on your tax return. So the number one thing that the IRS can easily red flag is if there's a tax form that doesn't line up with your tax return. So if they see a 1099-K for $600 and they don't see that $600 on your tax return somewhere, even if it nets out to $0, if they don't see that initial $600 somewhere, then it's going to flag the IRS and you'll be receiving a letter from them. So I can't tell you how many IRS notices I've seen that are just automatically generated like that because the person accidentally missed a tax form. And now that the 1099-K threshold is so low, I feel that we're just going to see more and more of these automatic letters that are sent out. And unfortunately, there's not too much you can do about them other than make sure you report all of your income on your tax return.
Right. I mean, a lot of people forget that, when you receive a tax form in the mail from one of these companies, you're not the only person getting it. It's going to the IRS as well. So you're much better off, whether or not you have a good reason for it, you deduct it, you have, your cost base is higher. It doesn't really matter what you do with it. It's better to at least report it than not, because the IRS will know about it regardless of whether you try to hide it or not.
Exactly. Yes. Yep.
So then going forward, there's some tax change number 8. There's some interesting things becoming available for in regards to employer matches on simple and SEP IRA plans. So get into that a little bit. What does that look like?
So our eighth tax change has to do with the fact that employers are now able to offer Roth Simple and SEP IRA plans for both employer and employee contributions. So this means that employees can now decide whether to take employer matching contributions on a pre-tax or on a Roth basis. So this really does depend on if the employer plan offers it. So it's not going to be every plan, but if your employer plan does have the capability to offer Roth contributions, then you have the option to switch your employer matches to that Roth basis. So this is part of the push for Washington to have more Roth money coming in. Roth money means that you are paying taxes on it now. So it's a good way to raise tax revenue in Washington. And I mean, we're fans of the Roth, especially if you're younger. So it's a good option for a lot of employees.
Absolutely. It always comes back to the government wanting their taxes now. It's the same reasoning for the Benny IRA 10-year rule and all of the other rules regarding them wanting their tax revenue right now and not later.
Right. So something to keep in mind, if you do change your contributions from pre-tax to Roth, so let's say you are maxing out your 401k or something along those lines. If you were previously doing pre-tax and you switch it to being 100% Roth, that will increase your taxes for the year. So you were previously getting a tax deduction, and now you are not getting that tax deduction. In fact, you're actually paying taxes on those contributions. So something to keep in mind. We see this from time to time when clients just accidentally switch 100% from pre-tax to Roth, and then they get a pretty big tax bill come tax time. So generally there's a kind of a good sort of sweet spot between there where you do a little bit of pre-tax, a little bit of Roth, just to kind of counteract the effects of each of them.
Right. I mean, when you're getting this money on an after-tax basis, it's great for a lot of reasons, but it is easy to forget that it is money coming to you that taxes have been paid on. So it is income to you, and yes, important to remember so you're not surprised on your tax return.
Yeah. And we help clients with that all the time here. So trying to figure out how much they should do on the pre-tax level or on the Roth level, depending on their specific income circumstances. So not everybody's tax return is going to look the same. So we want to make sure that we're doing what would be the best strategically for them.
Right. It's not the same exact shelter of income that a traditional retirement plan would be. It functions a little bit differently, and while it may benefit you later on with all of that tax-free growth, it is going to affect you in the short term a little bit. So something to think about. And then, so another change going forward, qualified charitable distribution and annual gift limits increase. So this one's pretty simple. The QCD amount has increased from $105,000 to $108,000 in 2025. That is on a yearly basis. It's linked to inflation, so it's expected to increase every year going forward. And then the annual federal gift exclusion has increased from $18,000 in 2024 to $19,000 in 2025. So just a nice little boost in terms of what you can give to others, as well as what you can give to charities and churches, nonprofits, that sort of thing. A good little boost. A lot of our clients take advantage of those QCD benefits, and I think this will help and affect a lot of people.
Right. And always keep in mind that when you gift something, it is not taxable to you or the recipient. So if you gift over these limits, that just means you have to file a gift tax return, but it still does not necessarily mean that it's going to be taxable to either you or the recipient.
Right. Important to remember, I get that question a lot, is how much I can give on a yearly basis without paying taxes, and people, that's just a filing and reporting limit. It's not a tax limit. So in reality, you're fine more than likely most of the time.
Yep. And then the last tax change we have here, so number 10, this is one that actually benefits everybody. So we have a small decrease to the underpayment tax penalty. So kind of what this is the U.S. utilizes a pay-as-you-go approach, meaning the IRS expects you to remit taxes throughout the year based upon your estimated income. It's typically done through W-2 withholding if you're an employee, or quarterly payments if you're self-employed or if you're retired. So now this penalty has gone down from 8% down to 7%. So it's still pretty high. 7% is still a hefty penalty, but it has decreased. So that is good news for individuals out there.
Absolutely, yeah. A lot of our clients are or should be making quarterly payments, and this is a good thing for if you happen to miss that quarterly payment. The IRS does expect you to make them throughout the year, especially if you don't have a typical job where you're paid on a W-2 basis and the withholding is given or withheld throughout the year. They expect you to pay. So a good little boost. You don't have to pay them as much when you miss that.
Sure.
So, yep, those are our top 10 tax changes for the year. This has been Chet Cowart and Kristin Castello with Dollars and Cents, Nelson Financial Planning. We are here to help. We have no account minimums. We give consultations at a no obligation basis. Don't hesitate to reach out and contact us for help with any of these tax changes, as well as anything regarding your finances. Visit us at www.nelsonfinancialplanning.com, and we have a whole host of ways to get in contact with us. Once again, this has been Chet Cowart, Certified Financial Fiduciary, Kristin Castello, Certified Financial Fiduciary at Nelson Financial Planning.